You are listening to KSG Podcast. This is a short, crisp, concise, exam-oriented, edited editorial for civil services aspirants. In this podcast, we are going to talk about what links oil and food prices. The source for the content is Harish Tamodran's article for the Indian Express. Recently, the UN Food and Agriculture Organization released data showing its World Food Price Index or FPI averaging 133.2 points in October, the highest since July 2011. No less significant, though, is the way the FPI has oscillated since the outbreak of COVID-19. In May 2020, when the global economy was in the doldrums, it has collapsed to a 4-year low of 91.1 points. From there to a 10.25-year high now has been quite a climb. Much of this roller coaster has had to do with oil. April and May 2020 saw Brent crude prices crash to an average of $25.27 and $35.33 per barrel, respectively. In October 2021, it was $84.38 a barrel. One reason why petroleum and agriculture commodity prices move in tandem is the biofuels link. When crude prices rise, blending ethanol from sugarcane and corn, that is maize, with petrol or diverting palm and soybean oil for biodiesel production becomes that much more attractive. Cotton likewise turns relatively affordable vis-a-vis petrochemicals-based synthetic fibres. Also, since corn is primarily an animal feed, its diversion to ethanol leads to substitution by other grains, including wheat, for livestock use. That then pushes up prices of food grains as well. The same happens to sugar as mills step up the proportion of cane crushed for fermenting into alcohol. The results of these can be seen in the table. Palm oil prices in Malaysia are currently at over 5,070 ringgits per ton, with the most actively traded futures contract at the Bursa Malaysia Derivatives Exchange hitting a record intraday high of 5,090 ringgit on October 28th. On November 1, the benchmark wheat futures contract at the Chicago Board of Trade closed at $7.97 per bushel, the highest since December 19, 2012. The present global cotton rates of 125 cents plus per pound was last seen in July 2011. Corn and sugar prices, too, are ruling way higher compared to a year ago. But it isn't the biofuels effect alone. Large price increases also tend to rub off on other farm produce through creation of positive sentiment. Thus, skimmed milk powder prices averaged $3,627 per ton at the Global Dairy Trade online portal's latest fortnightly auction on the 3rd of November, the highest since the $3,810 of 1st of July 2014. International coffee prices have nearly doubled in the last 1 year and, like most other agri-commodities, also strengthened along with crude oil in the last 3 months. Sentiment is, in turn, connected with two things. The first is, of course, demand returning with revival of economic activity worldwide amid receding pandemic cases and rising vaccination rates. The second is the flood of liquidity unleashed by the US Federal Reserve and other global central banks to limit the economic damage wreaked by COVID-19. The US Fed's total assets, mainly government bonds and mortgage-backed securities that it buys on its balance sheet, has expanded from $4,241.51 billion to $8,574.87 billion between 2nd of March 2020 and 1st of November 2021. All this money, combined with the policy-induced ultra-low global interest rates, has found its way into stock markets, startup investments, and also commodities. And since restoration of supply chains hasn't kept pace with the demand recovery, manifested in congestion at ports, shortage of shipping containers or vessels, and laborers yet to fully return to plantations, the overall result has been inflation. But has the surge in international prices benefited producers, especially farmers? To some extent, yes. Kapas, raw unginned cotton that is, today it is selling at 7,500 to 8,000 rupees per quintal in Rajkot market in Gujarat, well above the government's minimum support price of 6,025 rupees for long staple varieties. Soybean growers are similarly realizing 5,000 rupees plus per quintal rates in markets such as Ujjain and Latur against the MSP of 3,950. On the flip side, however, farmers are being forced to pay much more for fuel and fertilizers as their international prices also have shot up. Diesel is now retailing in Delhi at 86 rupees 67 paisa a litre. This is higher than the 70 rupees 46 paisa a litre a year ago, even after the centre's recent 10 rupee excise duty cut. That's it for this podcast. Thank you so much for listening. To join KSG India courses and to crack the ICE exam, visit ksgindia.com. You can also get a PDF of this podcast on ksgindia.com. Thanks for listening.